All right, good afternoon, everyone. Hello, welcome to Payden's 2020 Macro Outlook. The longest expansion continues, where we will be reviewing 2019, how our predictions panned out, as well as our forecast for 2020. I'm your host, Chase Curtis, National Accounts and RIA Services, covering the Midwest and Texas. We'll include the funds team contact info at the end of the presentation, so if you're not sure who your contact is, please stay tuned to the end of the presentation. Today, we have two of the best that Payden has to offer. Jeffrey Cleveland, Principal and Chief Economist, and Sid Saravat, Associate Economist. Jeffrey has been with Payden for over 13 years and Sid with us over 5. But before we begin, I'm going to go over a few housekeeping items to ensure we have a smooth webcast. You have access to Zoom's chat capability at the lower center of your screen where you can ask questions. We'll have a dedicated time at the end of the presentation to go over some Q&A. So please ask your questions throughout the presentation and we'll be able to answer those at the end of the presentation. This call will be recorded, so if you have to hop off, the webcast replay will be available on the Payden website. To receive the presentation, please contact funds@payden.com following the webcast. Now, while we can't guarantee anything when it comes to the markets in 2020, what I can guarantee is if you like Calvin and Hobbes or Dilbert cartoons, you're going to enjoy this afternoon's webinar. So without further ado, Jeffrey, Sid, take it away.
Well, hello, everyone. This is Jeffrey and Sid. And what better way to start an economic outlook than with a cartoon? That is actually, I think, the only way to start an economic outlook. And we have to go straight to Calvin and Hobbes for this. And I'll tell you, when I first saw this cartoon some years ago, I most certainly was in the Hobbes camp. I thought that Calvin was being absurd and, making his decisions based on very little information. But now, with the benefit of hindsight and having worked in this business for a while, I decided that no, Calvin is closer to the truth. I think the quote that I've heard is that focus is the art of knowing what to ignore. I would rephrase that to investing is the art of knowing what to ignore. And so much news headlines and noise is out there. And what we really plan to do today is hone in on the key themes that we think will drive the global macro backdrop and therefore drive markets in 2020. Before we do that, the two folks on the call today, myself, Jeffrey, and Sid.
Sid, everyone. Yep.
And perhaps a better way to introduce to introduce the economics team is a meme. So if you're on the internet often, you are familiar with memes. Here's one that I like. What my mom thinks we do at the television appearances, what we think we do, sort of Sherlock Holmes looking for that signal amidst the noise, and of course what the trading floor, the traders think we do.
And not to pick on our traders, but part of the reason is they are involved and they are getting a lot of noise daily. And so to them, it seems like we're just throwing darts, but we like to think that we're looking at signals.
The other thing we do is we produce content. So if you are receiving the chart of the week, for example, that is something that's cooked up in our kitchen. But also, from time to time, we do whiteboard videos, we do the point of view, and we do a lot of different presentations and ad hoc pieces that we send out. So if you're interested, it's free to subscribe. You just email us there, economics@payden.com, and we'll make sure you're on our distribution list. Without further ado, a little bit of a review, Sid, I think of last year. We think it's important to hold ourselves accountable every year and so that we can learn from our outlook. So a look back at what we predicted last year in December of 2018, and then how did we do?
And in fact, we actually just copy-pasted this slide. So that it's a screenshot of our outlook last year. And I think starting off right off the bat, the most important thing is we really thought that in Q4 of 2018, what was going on? There was a lot of anxiety in the markets. People were really concerned that this was the end of the economic expansion, not just in the US, but globally as well. And our strong view there was that we did not think that 2019 would see a recession in the US or globally. And I think largely we were right that the US economic expansion continued and global growth did slow somewhat, particularly in Europe, but we did not see the sort of recessionary outlook that you would have seen in a 08 style scenario. Labor markets were strong throughout the year, almost across the globe. So we gave ourselves a thumbs up. And we'll get into inflation a little bit, a little bit of a mixed bag there. We did see inflation start to pick back up, but it's still under the target for the US. But I think what's more important is our view on central banks, particularly for the Fed. We expected a more hawkish Fed, and right after this outlook, I think the Fed made a pretty big switch.
I think 2 weeks after we published
2 weeks after we did update it, and they went from going for pausing and hiking to actually cutting rates. So
the credit and equity part, I think, is important. We expected, as we headed into the year, I think this was a tough call actually to make in December of 2018, with the S&P down almost 20% from its cycle highs at that point. We expected, positive total return from the credit markets, and we certainly got that. Probably not as much as we did, better than we expected.
Yeah, we did better than we anticipated,
and on equities as well. But we did expect more upside there, and we expected a little bit of a weaker dollar, and the dollar was sort of trading sideways. Okay, so let's look ahead into the future. What does 2020 have in store? And for that, maybe a Dilbert cartoon is appropriate. They hired a chief economist at the firm there, and he's asked to opine on different things. But of course, he says, I don't want to have an oversupply of wisdom. And as we said, it's not that we want to, we want to cut through a lot of the noise. So it's really two key factors, two key themes, if you will, that we think are going to set the stage from a global macro perspective. Number one, we think that global economic data is bottoming. We see evidence of a bottoming, and we will get into that a bit further. And at the same time, we see a monetary policy tailwind, not just the Fed, but global central banks as well, easing monetary policy. And we think these two factors will provide the global economic backdrop in 2020.
Yeah, and to understand why we think that we are seeing global data bottoming, or we think what is a third mini cycle, I think it's important to look at this chart. What we're looking at here is the Global Manufacturing Purchasing Managers Index. So it's very difficult, obviously, to compare data points across different countries, different regions. So we rely on this PMI data, which is a survey of purchasing managers. These are people who are supplying their factories, ordering equipment in the industrial sector. And it surveys most countries in the world that account for around 90% of global manufacturing output. The reason for focusing on the manufacturing sector is it tends to be more cyclical. And so we've seen a slowdown in 2011, 2012, right around the Euro crisis. We saw another slowdown in 2015, 2016 with the energy sector. And our view in 2019 and for the rest of the year in 2020 is that we've seen a third mini cycle, and this is starting to bottom out. We already see that it improved for 4 straight months and is now above the critical value of 50. What it does is 50 tells us that more purchasing managers across the globe think that their sector is expanding. A value below 50 indicates a contraction. Now, to understand why it's important, you can also look at global GDP, and this does tend to track global GDP fairly well. The PMI data does. And so the PMI data is the blue line. We're starting to see it bottom out. As it picks up, we expect global growth to pick up as well, right above 3%. Our forecast is 3.4% from last year's 2.9 or 3%. We're still getting all the data in. Now, on a more granular level, it's important to understand that what can be masked by the global PMI is that it is a collection of PMIs from different countries. So here we've taken that data, mapped it out using major economies of the world. Again, above, and the size of the circle, if you're wondering, represents how much weight that country has in the overall global PMI. And it indicates that country's importance to global manufacturing and to global growth. So it's important to look at above and below 50. That's the main thing you should take out of this chart. If a bubble is above 50, those sectors, those countries are expanding. Below 50 indicates they're contracting. Left to right, you have to see if it's below 0 on the left, that means it's declining compared to a year ago. And if it's above, it's expanding compared to a year ago. Top right corner, that's really where you want to see your economies. But even if they're above 50, that's what's important. So we started 2019 with most January 2019 data is what you have on your screen. Most of the economies in the world were in expansion. The global PMI was above 50. You had some slowdown in China, some signs of a slowdown in Germany. We thought that was sentiment driven, it would turn. However, fast forward to the summer, and this is what we saw. And you saw this previously too in that line chart where it was below 50. Most countries and the world's industrial production fell into contraction. Germany in particular actually reached almost a 20 to 30 year low on their data. I'm saying 20 to 30 year, it's basically as low as far back as the data goes. And so we're really hurt by the auto sector slowdown, issues with obviously with trade concerns around the world, and overall slowing growth. And so we actually saw the US manage to stay just afloat. But this is a time when a lot of market participants were starting to get worried. The reason we remained somewhat optimistic and expected the data to bottom out is because overall, all these countries, including Germany, the labor market remained resilient. Unemployment rates continued to fall, particularly in the US, but also in the Eurozone. And overall, the service sector, which we haven't shown here, and which is now the majority of global growth, stayed above 50. That service sector PMI only fell as low as 51. So closing out the year, 2019, this is the latest data we have. It says today, but this is December data. We started to see economies move back above 50. Particularly, I'm going to point to US and China. China's data has gone back above 50, almost right in line with the trade tensions easing. Now, the more pessimistic forecaster would argue that the Eurozone is still negative, and it is, and particularly Germany, but we are seeing signs of bottoming there as well. A recent survey out of Germany called the ZEW survey, which surveys CEOs and other business leaders and is actually a very effective leading indicator for German economic growth, just showed its most positive result since 2015. And that's a sign that the German economy too is starting to pick back up with the resolution in some trade tensions, but also continued easy policy out of the ECB. They don't seem to be moving anywhere. And some resolution with an issue that has plagued the Eurozone, which is Brexit. Now, that was a lot of scatter plots.
There were quite a few scatter plots, Sid.
So we'll take a little break before you are inflicted with PowerPoint poisoning.
Catch your breath.
And moving on to our next section.
So the global economy slowed over the course of really late 2018 into 2019. We saw evidence of bottoming over the last 3 or 4 months. So tentative signs are popping up in the data really in Q4 of last year. And we think this is the third of these mini cycles that we've seen play out, driven by manufacturing. The question is, so that's the first pillar. Second pillar is the global financial backdrop, and it's the Fed, but it's also many global central banks and the shift in their positioning in the last 18 months. So if you look at 2018, most global central banks, the major global central banks, were in hiking mode. So the Fed, chief among them, hiking throughout 2018 into 2019, then stopping and pivoting and shifting gears. So you see that with the blue versus the green. It's almost a mirror image. A lot of central banks hiking and then a lot of central banks cutting in 2019. A few hikes there in 2019, just a handful of global central banks, but by and large, there was a monetary policy shift that happened. So if you think, again, back to the fall of 2018, the perspective was that the Fed was continuing to hike, would over-tighten, and that sword hung over financial markets, and I think contributed to a lot of the weakness that we saw in December of 2018. Tide has entirely shifted now, and we have central banks in easy mode. And I think this is really important because I think the Fed is largely to blame for the weakness that we've seen in global manufacturing over the last few years. So this chart shows you the manufacturing and PMI data globally that Sid had talked about versus the US dollar. So as the Fed hiked policy or tightened policy in 2015 and 2016, for example, the dollar strengthened. And much of the global economy depends on dollar-based financing in terms of bank loans and debt issuance in order to finance supply chains around the world. And so much of global trade is indexed still today in the dollar. So anything that happens with the dollar really has an outsized impact on the global economy.
Now, Jeffrey, if you were paying attention to the news throughout the year, it seemed like it was all about trade policy. But do you think this seems like an underappreciated reason for the global slowdown?
I think the tariffs and the trade story are important, but the big story is the Fed's role and the dollar strength. Why do we say that? Because the global PMI was actually weakening and global trade was actually slowing before Mr. Trump really ramped up the tariff tensions last year. So we already had a slowdown underway, and I think that was due to the Fed's tightening and dollar strength. You saw that in 2015, 2016. We didn't have a tariff issue there, but we had a slowdown in global manufacturing. And then you see it on this chart again as the Fed hikes in the 2017, 2018 period. The dollar strengthens and global trade and global manufacturing slow. So it could be that while Trump steals a lot of the thunder and the tariffs get a lot of attention, the real slowdown had already begun. It was a Fed story. So now that the Fed has shifted back to easing, we think this is a really important part of the story. It's a global story, so it's not just a U.S. story. We think that's really important to point out. How can we show that global financial conditions were tightening and now they're easing? Well, we chose to look at financial conditions indices. We show you 3 of them here. There is a Euro area index, there's a US index, and an emerging market economies index. And you can see the pattern as we've just discussed, tightening in conditions as you go, as the index increases above that 100 threshold. That's how you get into the tighter financial conditions. That happened, especially with the US, all through 2018 as the Fed hiked. And then with the Fed pivot in early January of 2019 and continuing with the actual rate cuts throughout last year, you see financial conditions loosen. So we think this is an important shift and it provides a big tailwind for financial markets.
Now, but you keep talking about the Fed and central banks. Isn't all this good news and better global growth? Maybe good news could be bad news and central banks come back online and start hiking again.
I appreciate you're playing the devil's advocate here. This is great. We hear that good news is bad news. Central banks are going to have to come into play.
Yep.
Why do we think that's not the case? This is the chart that we would point to, which is that we think the Fed, the bar for the Fed to move back to a tightening stance or move toward height, we think that bar is very high. And why? Well, inflation. So even if the global economic data and U.S. economic data look good as we expect, inflation is still below central bank target. Not only that, for the Fed, it's been below central bank target for quite some time. We're showing you here a green line is a 2% trend line for Core PCE since 2010. The blue line is the actual Core PCE, so the Fed's preferred inflation gauge, the actual performance since that time. On average, it's been 1.7, 1.8% year on year. But the key thing is you can tell it's been below a 2% trend line. The gap has only widened in the last year as inflation came in, as Sid mentioned, a little bit lower than expected. How much would inflation have to be over the next 3 or 4 years to return to that 2% trend line? 3%.
Right around 3%.
So the bar is very high. Even in our outlook for 2020, we don't see Core PCE much higher than 2.1, 2.2%. So 3% we think is a bit far-fetched, would be an outlier.
And I think Powell also said, right, he said it had to be sustained, that they're really shifting. They wanted to see go above the target. That I don't think they're going to panic. They're going to wait and see if it continues to be above target.
Right. So that's why we think at mid-year or thereabouts, the Fed could announce a change to its target range. Currently, it has a explicit 2% Core PCE target. You can see there's been a shortfall. The idea would be that they wouldn't mind seeing inflation above 2% for some time to make up for this shortfall. And so they would announce a new range, which we think would be something like a 1.5 to 2.5% range to signal to the market that they are willing to tolerate inflation a bit higher for some time. But the bottom line for us is this means the Fed is on hold or even easing further in the foreseeable future. Very high bar for hiking. So even if we get good news on the economic front, inflation is the key focus here for the Fed going forward. This is true, I think, also for the ECB. We heard from Lagarde today at the press conference out of the ECB. Said they're going to do really replicate what the Fed did in 2019, which was the Fed listens event.
Yep.
They're going to reevaluate their entire framework. So, and we think inflation is a key part of that story. So central banks in easy mode until inflation actually perks up.
Now, one of the things we heard a lot last year was, okay, a big part of what was keeping global growth up was the U.S. consumer.
Yes.
It's a big contributor to global growth, obviously a large contributor to U.S. economic growth. And now that we are officially in the longest expansion, is that something we should be worried about, and shouldn't the consumer start to weaken?
Well, the way we look at that is very simply tracking the monthly data on employment, on wages, on hours worked, and trying to generate a proxy for consumer purchasing power, because 72% of US GDP is the consumer is purchasing, and just tracking that in real time, I think is the best check on whether the consumer's health is improving or decelerating. This is a way we like to portray that here with our consumer power index, as Sid likes to call it, and it's still pointing towards growth of 2%, maybe a little bit higher. So I think in terms of thinking about our forecast for GDP for 2020, we still think we can see a number above 2% for the full year, which is right above trend for the U.S. economy. So we think the consumer is in good shape. Some people say to us, well, no, we hear about student loan debt, Sid. We hear about household debt levels at all-time high. Mortgage debt. I saw yesterday, CNBC, the average consumer doesn't have even $1,000, if they had to pay a large medical bill, for example. Isn't that, anecdotal evidence at least of weakness, of vulnerability in the consumer? How should we think about that, particularly debt levels?
Well, I think the best way to think about it, given that we do manage a lot of bonds, is how do you look at a bond of a company, right? It's all about, not about how much debt they have, but are they generating the cash to pay off the debt and to pay the coupon to us, the bondholder? And I think that's a good framework of thinking about the economy. And the way we do that here is we use Fed data that shows, okay, let's take the debt, mortgage debt, consumer debt, and then take the income. So can these consumers service that debt? And so you create a debt service ratio. They also created a financial obligation ratio, which includes rent payments. They try to include auto lease payments. Now, I think it's important to know this isn't perfect data. It's not that this percentage is the perfect illustration of a consumer's debt load. However, the trends are important. And right now, it's actually lower than it was at any point in the previous cycle. And it's not trending upwards. And we do see here, we have a short history, but we do see this start to tick back up when the cycle is coming to an end, or where the consumer is becoming over levered. And with the current numbers and the current trends in both these ratios, I think it's fair to say that the consumer is maybe not as overburdened as some anecdotes might suggest, particularly anecdotes of people living in a expensive city.
Yeah, I think so. You see that in 2001, you see that again in 2007. Those were two times where the consumer was particularly vulnerable on these measures. Today, this is the consumer is in better shape. And as long as the labor market holds up as we expect, we think the consumer will again be a solid boost to GDP in 2020. The other, I think, bright story for me is housing. Housing, it's a bit ironic, I suppose, as the global economy weakened, manufacturing weakened last year, 10-year treasury yields fell, mortgage rates fell in concert, and that had a consequence of boosting home buyer traffic, but also new home sales. We're also seeing a pickup in new construction activity. So housing starts ticked up to a cycle high in the latest month of data. So putting all of that into the mix and thinking about housing, we expect housing will be a positive contributor to growth in 2020, will boost GDP. And that is a very good sign. The time to be really worried, I think, was, as you see on our chart, that 06, 07 period where housing was already slowing. And housing, particularly home construction, slowdowns in home construction preceded 9 of the last 11 recessions. So that would be really worrisome. Right now, we're actually seeing the opposite. We're seeing a pickup. So that's a good sign. So I think the message here for me, Sid, is I've heard constant chatter that we're at the end of the cycle. The end is near. The cycle is about to be over. You know, you just have to repent.
The end is coming.
Yes.
Yes.
We still feel strongly that the end is not right around the corner. We will get through another year in the U.S. without a recession.
And I think it's Ben Bernanke who said that economic expansions don't die of old age. And then he continued and said they're murdered by the Fed.
Right.
So I think our view that the Fed's on hold right now really takes that out of the equation.
One of the big culprits often of ending the business cycle would be the Fed, and it's on the sidelines right now and actively wanting to extend this cycle. We also think it's interesting to take note of the decade that we've been through, just how it's been great. It has been an entire decade, the decade of 2010s, without a downturn. This is the first time we've made it through an entire decade in recorded history. I think it's fair to say we have from the National Bureau of Economic Research, we have business cycle dating back to
1850.
Yeah, we don't have it now. My very good friend and colleague Vlad Milev saw this chart and he said to me, "Yeah, this is just U.S. focused. You know, this is not global." And I said, "You know what, Vlad, once again, you're right." So we created a version of this. Sid created this. So I'll let you.
Yeah, we
just
took. So it's really difficult to have, with the U.S. We have a dating committee. We have a recession dating committee that tells us when a recession's begun through various factors. For global data, we just took IMF data for every single economy that they have data for going back to 1980, and looked at countries which had recorded a year of negative growth. And then we looked at the share of countries that had recorded positive growth. And we find that 2019 was not the best year since 1980, but definitely the best year since 2007, with the smallest share of countries since 2007 recording negative growth. And in 2020, the IMF, and we expect that to be even better. And so that's a good sign globally as well, that most economies in the world are not contracting and are growing, and if we're right, we expect them to pick back up next year.
So 2 big themes: the bottoming that we are detecting in the global economic data, coupled with a monetary policy tailwind, a global tailwind, really driven by the Fed and the shift. We think this is a great backdrop for the global economy, for the U.S. economy, and for financial markets. And we want to now, tie it back more explicitly to what we expect in terms of our economic and investment implications. Before we do that, why not stop for another cartoon? I mean, it's good. It's a good stopping point. I like this cartoon because, well, it's a new year, and I was talking to my sister Sid about the new year and asking her what are her sort of resolutions, and my sister sharply retorted that you shouldn't wait until the start of a new year to change something in your life that you need to change. You should already be doing that. That's her take on New Year's resolutions. This is Calvin's take. And I sort of agree with my sister in terms of our outlook. Our outlook hasn't changed, I think, all that much, given that
because it's a new year.
We flipped a new calendar. We're still upbeat on things. But here's sort of the summary of what we're expecting, what we've talked about here, and some of the economic implications.
So we do expect global economic activity to bottom. We think it'll pick up in early 2020. And if anything, we would be surprised if there is an upside surprise in Europe. I did mention that European manufacturing sector is still below that number of 50, but we are seeing tentative signs of bottoming in data out of UK even, and Germany and France. And so we're hoping that data, if it does continue to be following this trend, you could see actually a potential upside from Europe. And Chinese economic data has also benefited definitely from the lower trade tensions. But we do have proxies of Chinese growth. One example is the Li Ka-shing Index, which looks at bank lending activity, electricity production, railway freight. And that's actually the latest data print is up almost 10% year over year. And that had actually slowed, to put that into context, it had slowed to 1% during the slowdown in 2015, 2016. And this time around, it had slowed to right under 6%. So that data is starting to pick up. And those economies are very important for our global outlook. And of course, in the US, we've already mentioned with the Fed in sidelines. Longest expansion continues in the US. I think GDP growth right around or above trend. And what that means is if GDP is at trend growth, we should expect the unemployment rate to continue to decline. And we should expect inflation to pick back up. Again, we've said it should exceed the 2% target. The Fed should probably shrug that. But the labor market will be strong. And we expect it actually to be the lowest, probably the lowest unemployment rate since 1950s. And to get to that value, you actually don't require a lot of job growth. Job growth could slow from its current pace of 180,000 to say 130,000. You could still get to that low unemployment number.
With all of this said, we do think bond yields, it's at least in the front end, are capped by global central banks. So 2-year bond yield we think is capped. We do see some scope for the yield curve and yield curves to steepen. Mm-hmm. So a 10-year yield could drift higher. To show that, I have to backtrack here a little bit. This is the benchmark 10-year U.S. Treasury yield over the last 10 years versus SID's Global Industrial Production Index. And you can see there is a tendency for 10-year treasuries to move in concert with industrial activity globally. We saw that in that 2015-16 period. We saw that in the 2011-12 period. And we saw that again last year. If we're right that global industrial activity is bottoming out and will pick up, then we probably can expect somewhat higher 10-year treasury yields in the year ahead. We still think this is a great backdrop for credit and for equities. So credit sectors in the bond market, in particular, I'm thinking of high yield. Mm-hmm. I'm thinking of high yield spreads in that environment. They still have some scope for tightening. The key thing for us is if you don't have a recession, then credit sectors can continue to do well. That's what we've known. Even if spreads are tight, it doesn't mean you need to expect a material widening in credit spreads. The time historically when you see a material spread widening is on the eve of a recession. Equities too. I mean, I think of myself as a bond market economist, so that means I'm unbiased when speaking about equities here. But I think you have a similar story there where you have upside to equities when the cycle has more room to go. We saw that, Sid. I think probably the best example.
1998.
Yes.
Yeah.
So
yeah, right around that time we had, if you remember, the Asian financial crisis. So you had some concerns about global growth. And at the time, it had been the longest economic expansion on record. And you also had a president going through impeachment. So a lot of parallels could be drawn. And
rate cuts.
Exactly. The Fed had just cut rates, I think, three times, and had gone on hold. And if we see ourselves in that environment, we all know what happened after as the economic expansion continued and equities upside continued as well. And so we still think that could happen this year as well.
Final piece of the macro puzzle is the dollar.
Yeah.
So I think consistent with our view is a somewhat weaker dollar. If we're right that the Fed and the tightening drove the dollar stronger and hit manufacturing activity, and now the tide has turned, then we should have a bit of a weaker dollar in the year ahead. We also noticed that the dollar does tend to move counter-cyclically to global economic activity.
Yeah.
So if global economic activity is picking up, the dollar should weaken somewhat. Now, Sid.
Risks are very important because we started this presentation looking at where we were right and where we were wrong last year.
Yes.
So keeping that in mind, we don't know where we are by the end of this year, but we do know what we can watch to see if we should change our view. And you did mention, you don't change your view just because it's a new year. So throughout the year, I think if you're not able to get on a call with us, what should you be looking at to see if we're changing our view?
These are the 4 things that if we see, happen, we will change our outlook. So number 1, a lot of the backdrop is driven by the U.S. consumer, and the U.S. consumer strength is underpinned by the labor market. So looking at that in real time, and we found historically over the last few cycles, the best way to get a lead on labor market weakness is actually to look at initial claims. So the layoffs data, we get that data every Thursday morning, 5:30 LA time. And we like it because it's weekly data, it's lightly revised, and it's relatively real time. It's about a 1 week lag. And we're looking for a spike. We're looking for a pickup in claims, about 10% on a year-on-year basis. That would be the threshold for which, after which we would change our view.
And it's very, very intuitive. Even after events like hurricanes or government shutdowns, you start to see that spike. Those are short-lived, and so it's in real time. It does give us it's almost like a pulse of the U.S. labor market, and that I think is an important data point to watch going forward in the year. I think also geopolitical uncertainty. We did mention that, while the dollar was important and the Fed was important, trade tensions did weigh on the industrial sector. They weighed particularly on Europe as well as China. And so if we do see that escalating, we can look at things like the geopolitical uncertainty index. And we can also look often at the dollar and seeing what the dollar is doing. If people are worried, they'll come back to it as a safe haven. And so we'll continue to watch that. And that could shift our view in the interim.
A lot of clients have said to me, hey, what about an upside inflation surprise? You have in your forecast, you have inflation you have the unemployment rate going to 3.2, 3.3%. Historically,
wage growth is starting to pick up.
Yeah. So can we expect an inflation surprise in the year ahead? We put that as, that's a potential risk. What we've noticed, though, I think is two things. We are seeing a decline in the unemployment rate, and we are seeing wage growth trend higher. So nominal wage growth in 2020, we think will be 3.5% year on year, maybe a little bit higher on the average hourly earnings metric. So we are seeing that. However, we've also noticed that we don't necessarily see that passing through into inflation. That has changed. So just because you see low employment doesn't mean you have to have inflation. I think that's important to highlight. What would make the Fed change? We highlighted earlier, they want to see more inflation. They'd like to see a catch up or a makeup. So we've thought about that. What would make them nervous? They say right now, oh yeah, well, we'd like to welcome more inflation. What would make their palms sweat? We thought 2.5% on Core PCE is something to watch. Right now we're at 1.7% Core PCE, so we're a ways away from that. So, but we think it's a lower probability scenario, but that would make them that would spook the Fed and make them more hawkish.
And of course, I think we mentioned a lot the global manufacturing PMI data. There's a lot of other data points, but this is a good one to track. We actually send out a monthly piece on this as well.
The global pulse.
And if that falls below 50 again, or if the Eurozone data continues to decline, and maybe these tentative signs of bottoming weren't really there, then we'll start to change our view and update our view on that as well.
So that's the presentation. What do you think?
Well, we hope it doesn't. What your questions don't represent this cartoon, but we'd love to take any questions at this point.
Thank you, Jeffrey and Sid. I have to say that I personally didn't realize how much Calvin and Hobbes had to say about economics. But for everyone else on the line, just a quick reminder, if you didn't ask your question during the webcast or if you missed the instructions at the beginning, to enter your question, there should be a chat capability at the lower center part of your screen that says Q&A. So go ahead and enter in your question there. We did have a few come in during the presentation, and we're going to start out with the first one here. Will we ever see a U.S. manufacturing comeback, or is the U.S. cemented as a service-driven economy?
So we have seen the service sector now responsible for more and more of the economy. I think the last data we looked at is around 70%. But I will say this for manufacturing data, we are starting to see signs of bottoming in U.S. manufacturing data as well. Particularly, there are two indicators. One is the ISM manufacturing indicator, which has a longer history, and that's often quoted in the media. That's currently below 50. However, the PMI data from IHS, which is what provides us with the global data, that's actually above 50 right now. The reason for that difference is that the IHS PMI data actually looks at a bigger sample of firms, whereas the ISM data focuses on bigger bellwether firms that often have more global revenue sources. As you can imagine, throughout this trade dispute, those firms, the sentiment in the purchasing managers at those firms has been negatively impacted. So we are starting to see signs of bottoming in the IHS data. We expect that to carry over to the ISM data, especially now that some trade tensions have cooled. Additionally, more higher frequency data from Federal Reserve districts, including the Philadelphia Fed, the New York Fed, they have their own districts manufacturing data. We've gotten 2 out of those 5, and this data generally filters well into the ISM data. Both of those in the last week have surprised to the upside. So you should start to see manufacturing pick back up. In a more longer term scenario, I will say this, that yes, manufacturing employment is a smaller part of the economy. But if you actually look at manufacturing output, the US produces more in terms of volume than it ever has before. And so I think that's just a sign of improved technology. But it's not to say that, service sector jobs aren't more than making up for the job growth declines in manufacturing.
Great. Thank you. We've got a lot of questions coming in here. So I'm going to move to the next one. Is market valuation a concern? It would seem a lot of the good news is being priced in. Can you discuss your thoughts on market valuation?
Well, in the interest of full disclosure, I should say that we originally put together our outlook in December. So the December 11th, I think, is when we published the outlook. And at that time, it was very similar. We expected an upside to equities. Equities have surprised me in terms of the performance in the interim. So there is a degree with this story has been priced in to some degree, but in some ways it hasn't. So we still think the market hasn't fully bought into the global economic recovery. You see that, I think, reflected in bond yields. Bond yields are up from where they were in the summertime. So I think we were 140 on a 10-year treasury. Now we're closer to 170. So we're a little bit higher. But I think the bond market is still looking at the global economic data with a bit of skepticism, not really buying in to the global economic recovery story fully. The other way to think about like equity markets and risk markets in 2019 is that we did have really good performance, but some of that was flattered by the weakness that we had in Q4 of 2018. So you had a sell-off in stocks, and then stocks rallied back from that. We've compared the current period to the 1990s. And in the 1990s, you had much higher PE ratio, and you had much stronger equity performance. Annualized through the 90s was close to 14 or 15%. What we've seen in this current cycle for the US, for example, is something closer to 8 to 9%. So we don't yet see what we would call frothy or bubblicious valuations or sort of market performance yet. The other way to think about it is the late 1990s featured a pretty strong IPO market, lots of companies hundreds of companies coming to market and then seeing pops in their equity valuations. So you had a bit of a feeding frenzy, and we don't see that in the current market conditions.
Great, thank you. So we've multiple questions coming in on 2020, the election year, and the U.S. election. If the outcome, whether Republican or Democrat, would change your thinking or your outlook on what we'll see to come based on policies that will be enacted.
So we would turn that question around a little bit, and no, we will dodge that question. No, the way we're thinking about it is page 30. We skipped over this, so we'll go back to it. And we would just point out that the economy, we're stealing this phrase, one of Bill Clinton's advisors said it's the economy stupid in the early 1990s. So, if you're not familiar with that, we're not trying to offend anyone. That was an actual quote. But the idea is that the economy really matters for elections. And that election year was going to be the mid-90 election, so 96. And we think that's true. It's also worth noting that the presidential election is often not a national election, it's a regional election. It's a state-by-state election because of the Electoral College. So this is looking at swing states that are responsible for about 100 Electoral College votes. And it's looking at the unemployment rate since Trump took office. So January of 2017. Now, we're not saying he is responsible solely for this performance, but we just want to note here that the unemployment rates in every single one of these states has improved over that time period. And so if the economy counts for anything, it does argue for the incumbent in terms of the election outcome. And then, so I think that's really important to note, that backdrop. If we're right that we don't have a recession in the coming year, that should help in terms of the president's chances in November. I think also in terms of the economic backdrop, what could change, or what do we see as potential changes if we do see a turnover, if we do see the incumbent unseated and a new administration coming in? And all I can really say on that front is a lot of the policies that are talked about on the campaign trail are not actually or likely to be implemented when the new president comes in. So it's a bit of a warning for the primary season. A lot of the rhetoric is driven by appealing to your constituency. So in the Democrat side, much of that has moved to the left, to the more progressive type ideas that are getting a lot of press. But those things are more difficult to get implemented when you actually get into office. We would caution about too much market moves on that. I can't help but remember November of 2016, Sid. We got all of our strategists in a room and we said, okay, who's going to win the election? I think everyone was really on. We had one or two strategists that said Trump, but we had mostly
Hillary.
Yeah. Right. And then we said, okay, fine. What's the market reaction going to be? And it was a continuation of the current policy, so things would be fine. And then, okay, what if Trump gets elected? Oh, S&P is down major. And he's going to upend economic policy as we know it. And well, we know what happened, since we did have an initial sell-off in those early hours after the election, but then we had a pretty noticeable rally, and the rally has continued through the cycle. So I guess the lesson is often what you think you know about the incoming president and his or her economic policies, it's a much more complicated story, at least for markets.
And it's only further complicated because it's very difficult for us. We can look at labor market data, but it's very difficult to then not only predict who will be the president, but then predict what will happen to the other branches of government, which is equally important, and see what can be implemented. So that's a long way of saying we're not really sure. So we'll watch how the labor market data does, because that's something we can watch. And then more importantly, I think in the election year, it'll be important to see if any further escalation happens on the trade front or on regulatory policy that could move things, or at least move sentiment in the interim.
Great, fantastic. Another question here. How do we navigate global bonds if many countries have negative yielding debt, and do you ever foresee negative yields here in the U.S.?
I think it's first important to note that we have seen negative yields in the U.S. We saw it in 2011, 2014, and 2015. We saw T-bill yields trade briefly negative. Now, part of this is due to supply and demand story. If you remember, the Fed funds rate was actually close to zero at that time, so we're very close to the zero lower bound. It was short-lived. It was more of a flight to quality story. So that it's not impossible. We've actually seen it. The question we've been asking ourselves is, will we see the Fed pursue a negative interest rate policy? And while you never say never, right now what we understand from policymakers is that that is not a preferred policy path. In the minutes of the last FOMC meeting, in fact, they say all policymakers thought that avoiding a negative interest rate policy would be the right way to go. They think that there are a lot of tools in the monetary policy toolkit that they could wield before you would get there. So rate cuts, for example, forward guidance. They could say, hey, we're going to cut rates. We're going to keep rates low until we see a certain economic outcome or a certain period of time. We saw that last cycle. They could also restart asset purchases. Right now they're purchasing T-bills, but they could restart purchases of mortgages and treasuries, for example. So there's several steps that they could go to before they would get to a negative interest rate policy. Also, we do the point of view, as I mentioned at the get-go, the latest edition is the winter 2020 point of view. We have an article in there on this topic, on negative interest rates. So if you want more detail on that, I would refer you to that particular article.
Great, thank you. How about, can you comment on continued low unemployment, and will that translate into higher inflation? If you don't think it'll translate into higher inflation, why would that be?
This is the Phillips curve question, right, Sid? This is what's the relationship between unemployment and prices?
Yeah, and actually we did this whiteboard video on it, and we actually went back to the history of Bill Phillips, this economist from New Zealand, and what we found was, it's often taken as a law, but it's really just Bill Phillips needed a thesis, was looking at some data, making some scatter plots, and realized that there tended to be this relationship between the unemployment rate and wages. That was the original curve. Then economists came along, Paul Samuelson came along, decided, okay, well, actually, wages are going to pick up. People are going to buy more. Prices might be upward pressure. There might be some inflation. So real time, we can look at this. We have seen lower unemployment lead to higher wages. Maybe not the expectation of what was considered full employment was obviously breached, where the Fed thought full employment would happen at 4.5%. It was 4%, 3.5%. We've just gone lower. But we have seen wage growth pick back up to about 3%. We're expecting it to be higher. The difference this time is in this cycle, we haven't necessarily seen that strong link between wage growth and actual inflation. So maybe we're just not there yet. Maybe it's not a perfect linear relationship, but that is something that I think we continue to track. But again, as we've said, even if we do expect inflation to pick up, but we think the Fed still stays on the sidelines till they're really convinced that the relationship is back online.
Yeah, I think some people worry, the unemployment rate's low. That means the economy is running too hot. That means the Fed has to tighten. And what we're saying here is, the unemployment rate is going to go lower, but actually we still have slack.
Yes.
We think in the economy, we would measure that, in terms of looking at the share of 25 to 54-year-olds, the core working age population that has a job. And that reached a new cycle high in the December data, 80.4, but it's still below the all-time high, 81.9, we hit in the 1990s cycle. So we think there's more room for the labor market to tighten before we get to sort of tight in the labor market. So we don't really worry about that. In fact, Sid, I think it's fair to say we welcome that. Yeah. One of the best things that can happen, I think, for the U.S. economy, for the average U.S. worker, for a lot of things that people worry about, inequality, wage growth, everything like that, is having a tighter labor market. Yeah. So let's have a tighter labor market. Let's welcome that and not fear it.
Great, thank you. All right, so I think this will probably be the last question before we wrap things up. With credit spreads already tight, is there any part of the credit universe that you both find attractive, or at least relatively attractive, compared to the rest of the credit universe?
I think we got to go with high yield. Our friends Jordan Lopez, Nick Burns, the Payden high yield strategy team. That's still an area where spreads are a bit wider than perhaps some of the other pockets of the market. And we do think that fundamentally the U.S. economy is on a good footing. Much of U.S. high yield is more domestically focused. So that's an important piece of the puzzle. So if you had to flag up one value patch, that might be it. Now, I don't think anything's a screaming. This isn't December of 2018, unfortunately, but that's one.
And not to steal the line of our colleagues in the high yield fund group, but another thing that's happened also is a lot of the index is now higher quality.
Right.
So when people just compare spreads today to spreads in previous lows, it's not necessarily apples to apples, because you do have higher quality names, and something that they do in the fund that's great is they do look at security selection as well to avoid the losers. And so we think that if the economic expansion continues, we've seen in the past that they really start to spreads widen when a recession is either already happening or imminent. And since we're not there yet, we think that continues to be a good backdrop for spread product.
Would emerging market debt be a possible area of interest as well?
Absolutely, because part of this story here is that the Fed hiked throughout 2017 and 2018. That boosted the value of the US dollar. And one of the areas that bears the cost of that directly is the emerging markets, because so much of the world, as I mentioned earlier, is dependent on the US dollar either for financing. So bank loans are priced in dollars globally, or borrowing is done in dollars. Some countries borrow a lot in dollars, and then trade is financed. So dollar is just really important part. So if we're right that the Fed is now easing and the dollar should ease, that will help the emerging market backdrop mightily.
And additionally, a lot of the emerging market countries that we do look at are often very export oriented. And so any sign that these trade tensions are cooling, that should only further boost sentiment. And we saw that in November's data, actually, November's PMI data for China, the new export orders subcomponent jumped. I think it had the single biggest monthly gain since the data started recording in 2002. And that was on the back of trade tensions cooling down. So that also boosts sentiment in that asset class.
Fantastic. Well, thank you, Jeffrey and Sid, for joining us. And everyone on the line, thank you for joining us again. We have included our fund team's contact info here on this last page. If your question wasn't answered, feel free to email funds@payden.com and we'll get that answered to you directly. Also, if you want a copy of the presentation, email funds@payden.com and we will get that out to you. But until our next webcast, thank you for joining us, and we look forward to seeing you next time. Take care.